How's it going, everybody? It is Dennis, and we're back with another video. And today, as you can see, we're talking about a new fund that I'm investing into, and I've changed some positions to go ahead and put some money into it. And that is NEOS S&P 500 a High Income ETF, or SPYI. The reason I'm investing into SPYI is because you guys may or may not know, I've been thinking, and I am in the middle of switching my strategies into more option-based portfolio, meaning I'm switching most of my income that I'm making from dividends and from options into, rather than putting it to YieldMax and putting it to Rationale, I'm putting it now back into options, because for me, options is more income and safer for my portfolio, so risk tolerance is a little bit better, and I have full control of what trades I do and how much I am making on a weekly and monthly basis. But how does SPYI connect to all of this, and what did I sell to buy SPY? What dividends did I use? What am I doing? How am I investing into SPYI, and why am I investing into SPYI besides just the rebuilding of my portfolio? Well, we're going to get into it in just a second, and that is now. So looking at SPYI, what is SPYI? Well, obviously it's a high income ETF, as it is in the name, and because it has SPY in it, we understand that it trades on the S&P 500. They trade on the S&P 500 by having holdings of the S&P. They do that by running option strategies, by doing covered calls to earn income, which gives us a 12% yield, and they do quite safe trading. Over the past 1 year, they are up 5.10% while yielding us around 11.74% dividend yield, or $6.15 payouts. They also have dividend growth as well, which is very nice to see. As you can see, we're getting 48 prior, and we went up all the way up to the 50s now. So it's growing constantly with the dividends. So if you're buying in low, your dividends will grow as well. So you have dividend growth based on your investment, original investment. So there's that. They are trading options. They're doing covered calls. They do not have synthetics. They do trade on the index, so they do trade on SPX. So they do buy into the index, so they do kind of like leap trading. In some instances, they either do that or they buy the actual shares of companies. If we take a look at their holdings, we could see that they actually do hold percentages into Apple, Nvidia, and all that sorts. So they do buy actual shares into companies as well when need be, and they trade calls on that as well. So they just copy the S&P, and as you can see, they have the chart demonstrating that what their yields are comparative to what they're buying and writing. So in general, we understand they trade covered calls. We're not going to get into nitty gritty of how they do it. They trade covered calls either being on the SPX or on the stocks itself that are in the S&P 500 ETF. And they trade covered calls on that. They earn us income. They have a little bit of growth, not too much, but they earn us a steady 10 to 12% every single year. And for me, that is very important, because the same reason I've been investing into JEPQ, as you guys can see, I have around 3.16% of my portfolio, or 2.5K invested in JEPQ currently, and that is up currently almost 3%, or $73.83. And over the year, JEPQ is up 11.89%, while yielding us also around 9-10% yield. And the reason I'm going so heavy into this is because, like I said before, I'm switching into options trading. I need more stability in my account. YieldMax is great. YieldMax provides high dividends, but the stability is not there. There is NAV erosion. With NAV erosion comes margin buffers that gets lower. And I know a lot of people in the field, or in the finance YieldMax field that I'm in myself, have been talking about margin and buffer and all of that sorts. And that's very important if you're using margin. You want a high buffer so then you don't get margin called in case of a market downturn. And, you know, to be frank, I don't think we're going to have a huge market downturn, but it is seeming that the market is slowing down. Even looking at the S&P has been staying quite steady for quite a while. If we take a look right now at the S&P, if we open up another page, we can see for the past 3 months, the S&P has kind of stayed in the same range from 607 down to the low of 580, but it has been around the same range for almost 3 months. Year to date, it's only up 3.59% is quite significant, but that is from the low of January 10th, so that is to be counted as well. But for the past year, of course, it is up 22.67%, but as you can see, it's been kind of topping off, slowing down a little bit, especially with the new president, Donald Trump, being elected. There is some market instability in a way. So being that, you know, of course, you always have to protect your account, especially if you're trading margin. SPYI and JEPQ are just really safe, good investments for myself and my portfolio, and based on how I be trading. Like I mentioned before in every single video, I am not planning to sell YieldMax ETFs. just not at this moment at least. I don't think I'll be selling anytime in the future. I'll continue to harvest dividends that they're paying. I'm actually going to be getting dividends, as mentioned, on Wednesday from TSLY, GUI, YMAX, and QDTE for this week. And that's going to add another $500 into my account, roughly. And if we take a look at my account, we can see that my buying power currently is at 1,500. Or 1573.24 to be exact, right here on the bottom, right on the review order. So it's 1573 currently buying power. Another $500 are going to be added at the end of this week on Friday, the day this video is being uploaded and you're watching. Another $500 are being added to my account. That's up to $2,000. So that's almost, what is that? That's a quarter way to being able, or no, 1/4, yeah, a quarter way of being able to purchase myself another contract in the S&P. And if you guys do or do not know, I am trading poor man covered calls on the S&P. This is one of the calls that I own, or actually the only call that I own currently. And this one is up 11.2% or $986. I bought in at $8,800 or $88 per share, and now it's up to $9,786, so I'm up $986. And if we take a look at promised returns, we can see that if it continues to stay at 610, say the market stays stagnant for some reason for a whole year, I'll be down $1,700 or almost $1,800. But in that meantime, I'm earning $400 a week times 52. You could do the math. We'll still be profitable. For me to come out break even, I would need the market to rise, if we just keep clicking, around 3%. I need the S&P to rise around 3% for me to be break even, and that's technically historically possible from the S&P, assuming there's no market downturn or stagnation. And even then, if I decide to exit the position, I'll exit profitable during all of these months while we wait for the end of this contract to end. Or I could roll it over to next year and pay maybe $1,000, or maybe not pay anything at all, because I could roll it up and out, and maybe even roll out for a break even or for profits as well. And of course, poor man covered calls on that. I trade calls on top of it. Currently, I have a contract that I just actually moved over to next week. Today, Thursday, on February 20th, I moved over my contract to 615. I was at 613, rolled it up to 615, and made myself a good $130. And there you go, locked in $130 for this week. That's going to go ahead and wait until next week. And if we take a look at simulated returns, we can see if the market stays around $610, the S&P, I'll be able to make all my money back, even actually not a day before. On that day, in the morning at 8:30, I could just close the contract and I'll be good to go. Or 9:30, I could close the contract and I'll be good to go. Of course, if it goes up, it's going to take a little bit longer for me to actually make my money back. As long as it doesn't go over 615, we're solid. We've made our money. But that's just that's the trading that I'm doing currently. We're also doing contracts on the SPX as well, the same way as SPYI does trades on the index. We're doing trades on the index as well. I'm running a credit put strategy on the SPX currently, and this is yielding me $110 on $500 invested. So that is a 20, what is that? Yeah, that's a 20, almost 20% return in a matter of a month. It's pretty solid to me. And of course, we're also running TNA. We have contracts on TNA, which I'm currently looking to exit out of and go ahead and go into IWM, which is pretty much what TNA trades on, but it's not 3 times leveraged. But that in total is why I'm looking to continue to buy SPY, why I'm buying into JEPQ. The reason I decided to buy SPY was because it has a higher yield than JEPQ. It's stable as well because, it's the way they trade it. They give you a little bit more on the distribution side. So instead of having JEPQ that pays you 10%, 9 to 10% and have experienced some growth, here you're getting 12%, so 2% more, and you're having a tiny growth. Like, what was it before? It was around... On the 1 year, we had only 5% growth, right? So you have less growth on the upside with your share value, but at least you're getting more dividends, which you compound monthly. So in that sense, you are also winning on that side. How did I buy SPY? What did I use to buy SPY? Well, actually, I sold one out of my old positions, my very, very old positions, Main Street Capital. I've sold out of it for $1438.87. I was actually up 80% on Main Street Capital. Which is crazy. I've held that for 3 years, and I was up 80% on that. So I almost doubled my money on Main Street Capital while receiving dividends. That probably helped my doubling because of the dividends were being reinvested right back into it. So we sold out of that. Right as soon as we sold out of that, we bought on 27 shares of SPYI, and that will begin to start reinvesting into itself, as well as adding a little bit more money as I choose to do so. So, you know, I get some dividends. Like I mentioned before, I get some margin from the dividends. I go ahead and put some of it into JEPQ, put some of it into SPY, depending what I'm looking to buy in on that date, on that week, on that month. And of course, the other money will go back into YieldMax ETF. But that is it. That is pretty much what I am doing with SPYI, why I'm investing into SPYI. Like mentioned, it's JEPQ and SPYI. Those are my now main positions to hold my account together. They both offer stability as well as decent dividends, 10 to 12, 10%, 9 to 10% from JEPQ, 11 to 12% from SPYI. They both offer dividend growth as well as share value stability and growth. Of course, this is in a market that's been trending upwards. But even if we look at the max chart of SPY, we can see when they launched, they did drop down back in October of 2022 when we had a little bit of a market pullback. And during all the market pullbacks, it jumped back up as soon as the pullback was over. So assuming we for some reason have another market pullback, assuming S&P drops down, they'll probably get it back up there anyways. As we can see, we had a huge drop in August, but it went back up. We had a huge drop here in September, it went back up. So S&P always recovers, it's safe. QQQ always recovers, so JEPQ is safe. Of course, it's relative. Nothing is always safe in investments. This is not investment advice for you to just throw your money into this because I said it's safe. It's all relative. But in the same sense, on these drops that we saw, so here in August when we had that drop similar to SPY, if you bought down here, you would be up, let's see, 4%. We're down 5%. It's up 12%. You would have been up a little extra 4% on that as well. You bought here, you would be up. You bought here, you would be up, right? So all these downturns are buying opportunities. This is perfect for strategies that I run. I always like to buy cheap, dollar cost average in for cheap. So these are just buying opportunities right here throughout the couple months and years of trading. So for me, this is just the perfect thing. You know, I have QQQ with JEPQ. I have S&P with SPYI. I trade S&P myself. And of course, I have the poor man covered call strategy that's yielding me 12% in growth value, as well as dividends on the top side, which currently is a negative, but that's just, you know, value. And of course, I have my little strategy going on with my credit puts and credit calls, put credit spreads and put credit spreads and call credit spreads on the SPX, the index itself, since that's what Robinhood offers now. So that is how my portfolio is looking. That is why I'm putting my money into SPYI. I'm looking for stability currently, especially in this kind of weird market that we're in currently. SPYI bringing me stability. JEPQ is bringing me stability. And actually, I'm investing into bonds as well. It's kind of crazy for me to say. I do have some bonds that I've been putting money into, but that's mostly just cash. So if I have cash, say I have some extra cash laying around, I just put into a bonds that yield me around 4 or 5%. On that bonds, I take out margin. So while those bonds are just sitting there, saying for like, you know, saying it's an emergency fund or something like that, while the emergency fund's sitting there and the bonds are earning me dividends and reinvesting back into itself, I also have the margin making me higher returns. So the bonds are making me to 4 to 5%. The margin's returning me on SPY 12%, right? So it's a win-win. That's how my portfolio is running currently. I'm more, like you guys could see, I'm moving into more stability, more income based, but more income that's controlled by me rather than YieldMax or Curve or Roundhill or any of these fund managers. I'm just looking to control my own income and do what I could do best myself without having to pay anybody. Expense ratio, of course, you know, SPY also has an expense ratio of 0.68, but it's better than 1%, which is most of these fund managers, you know, are charging us. But in general, that is that. I will see you guys in the next video on Wednesday. We're going to be going over Group B's dividend distributions as well as Roundhill. But that is how my portfolio is looking as of today, February 21st, when you guys are seeing this video, or February 20th on myself. That is why I'm buying SPYI. That's why I'm buying JEPQ. I'm currently running poor man covered calls on SPY, on TNA, which will be switching to IWM. I'm running put credit spreads, and I'm earning good income on those strategies. And of course, I'm continuing to reinvest into YieldMax, into Roundhill. I'm not out of them yet. There's a video on that. I'm putting margin into them. I'm not putting the cash, but I'm putting the margin into it. So there's going to slow down a little bit. The growth is going to slow down in the portfolio on the YieldMax side, on the dividend side. But in the matter of 2 months, 3 at most, it's going to speed up really quick because we're going to get another contract out there on the S&P. That's going to add another $400, $500 a month into our portfolio. And that's just going to speed up the rate of how many contracts we're getting in, how much we're doing on trading, and how much income we're getting into the portfolio. So hopefully all goes well. I will see you guys once again on Wednesday. Thank you for watching. Hope you guys maybe leave some comments down below. Maybe I shouldn't have chose SPYI. Maybe there's some better funds out there with more NAV stability and safer, long-term ability or long-term business. But just give me your comments, give me your opinions down below. I love reading those and responding to you guys, as always. Always responding to your guys' comments. So be sure to like, subscribe, leave a comment. Love talking to you guys. See you guys on Wednesday.